Hello, welcome to Financial Insider Weekly. I'm your host, Michael Gray, CPA. I have a returning guest to my show today, Craig Martin, and Craig is a certified financial planner. He is one of the partners at the Family Wealth Consulting Group, which is a fee-only financial planning company. It's a husband, wife, and daughter team, and so I've had Craig and his wife, Peggy, and their daughter, Hillary, on the show with me here. Craig has been providing asset management services for 30 years.
Oof.
And anyway, we decided that enough is enough for his introduction. But thank you, Craig, for being with me here today.
I'm lucky to be on your show, Mike.
Oh.
You've had some legacy names from the community here.
Thank you
in
for
the
that.
financial planning community.
Yes.
We have talked several times about the work that you're doing, producing legacy work from the very best planners in the community. So I'm fortunate to be chosen to be on with you.
Okay, well, thank you for that. All right. Now, today, Craig and I are going to be talking mostly about real estate, but what I want to point out to you is this is going to be like a different wrinkle on real estate, because most people think of real estate as I'm going to go out and I'm going to do a rehab, I'm got to, get the plunger and clean the toilets and all those other things. So they think of real estate in a sense, I would say, more as a business. But we're going to be talking about real estate really as a part of an investment portfolio, because Craig's specialty is building risk-managed investment portfolios.
Yeah, most of my clients come to me, Mike, with, as do your clients too, with existing real estate. They bought the house in the 60s and 70s for $35,000, and suddenly it's worth, well, 2-3 years ago we said it was worth $1 million,
Yeah.
and today it's worth some $500,000-600,000 maybe, and they've been renting it out forever.
Yeah.
And what I discover is that their rate of return on that property is quite low.
Mm-hmm.
So as a fee-only financial planning firm, our job is to help clients make informed decisions.
Mm-hmm.
We help clients understand the tax and economic consequences of their choices.
Mm-hmm.
So a choice that a client has is to invest or not invest.
Mm-hmm.
And when they own a piece of real estate, they get the choice of holding that real estate this year or selling it and reinvesting it. Mm-hmm. The only reason they would want to sell it and reinvest it is if they could find something better. Mm-hmm. So what we want to do is help them understand what they've got, what are the tax and economic consequences of holding the real estate versus selling and reinvesting that real estate.
Mm-hmm. Okay. Now, from the investment portfolio standpoint, why should people consider making investments aside from stocks and bonds in building an investment portfolio?
Well, our expertise is helping clients build a risk-managed portfolio. Mm-hmm. So it turns out that a couple of people won a Nobel Prize in 1990 called Harry Markowitz and Bill Sharpe.
Yes.
For what is called modern portfolio theory. And their Nobel Prize was earned because they demonstrated how to build a risk-managed portfolio. Surprise, it works. Mm-hmm. In other words, we can show clients how to build a portfolio that has the highest expected return with the lowest volatility of returns. We call that risk. So when I mix dissimilar price movement asset classes together, I get a portfolio that's risk managed. Let me give a simple example of that. An all stock portfolio is going to earn the returns of the stock market. Mm-hmm. And it's going to do it with the volatility of the stock market. Mm-hmm. We can reduce that volatility by mixing it with something that's not stocks, mm-hmm. and has dissimilar price movement.
So when we say dissimilar price movement, we mean when the price of stock is up, the price of this other item is down, and when the price of the other item is up, the price of the stock is probably down.
That would be a perfect tool to
Yes.
find to build a risk-managed portfolio with.
Yes.
We would call that negative correlation,
Yes.
so that when we get one-to-one correlation, it means that the stock price moves 1 for 1.
Yes. They move together.
If it's -1, which is the most uncorrelated it can be,
Yes.
then as one goes up, the other goes down.
Right.
We don't have any investments that are -1 correlation.
Yeah.
It turns out that bonds are slightly negative, sometimes positive, mostly slightly negative. So it turns out that if we add bonds to an all-stock portfolio, we can build a portfolio that's got less risk than a 100% stock portfolio. And if we do this smartly, we can actually still get the returns of the stock market.
Okay.
A risk we suffer is that the more bonds we add, the lower the volatility of that stock portfolio, combined portfolio,
The combined portfolio.
until we finally get to the point where we have 100% in bonds, and bonds have a return, an expected return half that of stocks. So we don't consider 100% bonds an investment, it's a savings account, in contrast to the stocks, which are an investment account. So in an effort to build a risk-managed portfolio for our clients, what we're expert at is helping them find alternative asset classes. Those alternatives can include bonds, wow, or something different. How about real estate? Well, let's talk about real estate.
Right.
So real estate is a popular alternative investment in Silicon Valley particularly.
Okay.
Most people prior to 2007 bought real estate. As far as they were concerned, it always went up in value.
Yes.
And in many cases, people made more money from their real estate than they did from their stocks. But if I look at what clients paid for their real estate at the date of purchase and what it's worth today on the marketplace, I can calculate the compound rate of return of that equity portion of the real estate during their hold period. And it typically comes out to be less than 8% per year, closer to 6% per year. Each address, each client, each property is different, but it is less than if they had put their money into the stock market. In other words, real estate has a tradition of earning less money than the stock market.
So a lot of people may have a problem with that. And part of the reason is that a lot of people have their money sunk in real estate and they've seen it grow over the years, and fewer have had probably a real investment portfolio that they've hung on to.
That's the key.
For stocks.
Yeah, the key is buy and hold.
Uh-huh.
You're going to earn the returns of the real estate because you can't sell it every day.
Yes.
But because people can sell their stocks or bonds every day, they tend to have a pattern of doing that.
And the wrong pattern.
Yeah, the historical pattern of individual investors buying and selling stocks is quite poor.
Right.
That's a different discussion. We've had that one before.
Yes.
So this is about how real estate fits into that all stock portfolio.
Yes.
So if we can mix real estate with stocks, we can get a risk-reward ratio that's better than stocks and bonds. So we can reduce the risk of an all-stock portfolio by adding real estate to it, and we do not reduce the expected return of the combined portfolio as much as if we'd used bonds.
Right.